Hey, everybody, welcome to the morning market briefing, Freaky Friday edition. Friday the 13th. Hope you're doing well. Also, Valentine's Eve. Not that anyone out there would have forgotten, but quick reminder, get your cards, get your flowers. Stay on top of these things, folks. Got to be on it. Big day today, sort of. We got CPI coming in, Tom. Tom's in a real man versus machine battle with his computer, but I think we're going to I have confidence in Tom coming through on this, but on CPI, we're looking for a 0.3% increase on both the overall number month over month as well as the core, which would put us at 2.5 on the year over year and 2.5 on the core. How we feeling?
We're feeling hot.
Woo!
Because this number is cold. So CPI month over month came in at 0.2%. The core came in line at 0.3, sorry. And then the overall year over year is at 2.4%, and core stayed flat there at 2.5%. Notably, real average hourly earnings year over year up 1.2%, and the bond market is en fuego. So the 10-year opened today right around a 415. We were at a 407. The 30-year has dropped to a 470. So the haters and losers who said the most dangerous trade was the long bond are missing out on another 1% day over day move, because we got one of those yesterday too. The interesting thing is the headline. I've got the PDF pulled up from the Bureau of Labor Statistics, and the headline is month over month 0.2%. Shelter rises. Now, I did a little research yesterday. I asked Grok, I asked Gemini to tabulate all of the Zillow data to give me an idea for where in real-time data inflation was on housing. And it basically said that nationwide, we are roughly in a 0.2 negative year-over-year situation on housing for homes, and that we're somewhere between negative 0.5% and 1% increases in rent, depending on market. However, the expectation coming in today was that shelter inflation would be between 3.4 and 3.5%. And so the headline coming from the Bureau of Labor Statistics telling me that shelter is up month over month makes me think that 2.4 might still be extraordinarily high. So I'm pulling up the data now.
Which we've talked about for a while. I mean, the shelter component continues to operate at a lag. It continues to be calculated in a method. I feel like all we've done all week is just crap all over official data points. But I'm not going to change the narrative of the week. But, I mean, we have bemoaned the calculation, the owner's equivalent rent tabulation for the entirety of the history of this venture of the morning market briefing. So this is not new. We're not changing our mind on this. But the reality is that is a major component of CPI. And historically, if you go back through the annals of this call, there were periods in which I think it was undercounting, and inflation was probably on a realistic level significantly higher than what CPI might have been showing. And right now we're on a period where I would argue that the actual data on home prices and rent prices would suggest that we're propping up inflation with this data.
Inflation would be, I mean, it's really one of the high points of all the data. I mean, the only thing that's higher than it would be food away from home year over year. Pretty much everything else is in line. And utility piped gas service is up 9.8, and then electricity up 6.3. We all know where that's coming from, data centers. But like notably, the annualized number on gasoline down 7.3%, fuel oil down 4%. I'm looking through all these things. I mean, some of them are up. Transportation services up 1.3 annualized. But shelter being up 3 is really holding up because it's a massive piece of the entire pie. I mean, used cars are annualizing at negative 2% year over year. They're down 1.8% month over month. And so there's a huge drag on inflation in everything except for the biggest component, which is shelter. And the real-time data suggests that this is very stale. So I think the bond market is picking up on this in a very fast way. I mean, we're just cruising right now. I mean, we touched a 405 on the 10-year. We're back up to right around a 407. But, man, I mean, inflation expectations, you should whack off I'd call it at least 0.2 from there, and say we're probably closer to 2.2, if not 2%, because that number.
Chill.
Because the most important number is obviously wrong. We talked about it yesterday with the jobs thing. Like, what if you just asked ChatGPT or Gemini, what is real?
How many people are working?
Yeah, how many people are working? What's the real time data if you just scrape the data from Zillow? And the answer is we're basically flat to down on shelter inflation, and this number is wrong. And so that's pretty interesting. But I'm interested to see what the market is doing in terms of futures, because my expectation would be that this is actually negative for equities, because the number of cuts that are proposed or coming or anticipated is going to drop really fast, because you tie that together with the jobs report that, whether or not you take it seriously, the trend is showing that there probably shouldn't be more rate cuts. But actually, now I'm looking at it, we've actually gone up to 2.4 cuts this year
that makes no sense,
which is a little bit higher than we were at the end of the day yesterday, which was like 2.3. So
we're at like a 407 on the 10-year. We talked about, really the range-bound nature of the 10-year and where we've been for the last, 6 months. How quick does it go back to 4.2? A week?
It could be as short as a week. We'll see if it holds through the day, but I think that this is a pretty strong indicator. A lot of the fluctuations last year came from the University of Michigan, which at some points was off by more than 4% of what the actual number was. And so now we're continuing to move that way. People aren't looking at that seriously anymore. The hourly earnings stuff is basically flat. 1.2% is not mind-blowing year over year. Those numbers were in the low single digits in 2022. So, this is a big banner day. And I texted yesterday with Ben. I was like, this could be the beginning of the end of the long-term interest rates being high. I sort of worry that we didn't buy enough of the long bond. I know I've talked about it for 6 months, but moving bond portfolios around is like turning the Titanic.
Yeah, it takes time.
It takes time. You need bonds to mature. You need equity markets to run up, and you can only do a little bit at a time. And I'm happy. I was looking at bonds we bought last week. I talked about it on these calls. We bought some like 135s of 52. They're, nobody really wants those bonds because they've got a very low coupon. They're going to trade wider of the yield curve because you're not getting that income. All you're really doing is buying pure duration. We were buying those at like 47 and change cents on the dollar, and those were over 50 cents yesterday. They're going to be well over that today. We might see a 1.5% move on those 2 consecutive days, just because of the way the yield curve is moving. We got the best 30-year auction yesterday, certainly that I've ever seen. It was sort of difficult to line up all the data to say if it was the best 30-year auction of all time, but it was the most bonds that were purchased at the auction. The primaries were left with 5.9%. So everyone talks about the weird inner dealings with the major investment banks where the issuers are technically Goldman Sachs and all that. They didn't have to buy really any of them, less than 6%. Indirects, everyone's talking about how every country hates the U.S., doesn't want to buy our treasuries. China
are gobbling up our debt.
Yeah, they took 70% of it. And then the rest went to those who were bidding on it. And the bid to cover was 2.6 times. The average for the 30-year for like the last 6 months is like right at 2.3. So like 15% more people were trying to get that 30-year bond yesterday. They tried to issue it at 477. It came in at a 475. So people paid up to get it. And then it continued to fall. And now those people are way up because they got another 5 bips just this morning. Yeah. So, man, feeling good. It could all unwind, but the good news is, when the 30-year was closer to 5, we were buying there, and now it's at a 470. So we've got a nice buffer.
Yep. Yeah, we got cushion there. Equity futures really not moving much. They were down just a little bit when the call started. They're still down just a little bit. Not much movement there. Let's talk some companies. Relic's a company that's in a number of client portfolios, up about 4.5%. Nice read on the revenue, up 7%. Operating margin ticking up. Strong performance amid kind of an AI transformation, and a bit of optimism. They increased the dividend, announced a pretty sizable buyback. What other takeaways do you have from them?
Yeah, I was a little worried about the stock. This is a stock that Ben has pitched and is very hot on. They're a British company. Surprise, surprise.
Yeah.
But they own LexisNexis and a lot of the medical journals and all of the textbooks involved. And I was a little worried because AI could just market correct that very quickly. But it sounds like they've done a great job of essentially streamlining the use of those for attorneys and doctors to search.
Gatekeeping.
Yeah, so they can use AI within it, but it's not necessarily public. Not to besmirch Ben as he begins his marathon out in Arizona. Probably
is it
sometime.
Today? Is the run today?
I think it's today. Saturday morning. So he's probably listening live right now.
Yeah.
So I don't want to speak ill of Ben on his one rest day before he embarks on his great journey to qualify for the Boston Marathon. But a lot of people are saying that a lot of the properties held within the Relics universe were aggregated and sold to Relics by a little-known man named the father of Ghislaine Maxwell. So he was a British guy who basically gobbled up all of the legal and science journals and textbooks, bundled them into one company, and rolled them up into what is now Relics. Made a lot of money, and it seems like that money was not put to good use over the next decade or so.
Questionable use of proceeds there, to say the least.
Yeah, moral hazard, I think, is the term for that.
Yeah, so, I will say I was curious because you brought that to my attention. Simultaneous to Ben being really into Relics, I did search one of the databases. Ben is not named in the Epstein files.
Oh, that's good.
I know there's been a lot of
Did you go to jmail.com?
Yeah, I know there's been a lot of speculation about one Benjamin John Richard Nye, but he is not in there.
But not the famous makeup guy's not in there either. Because you forget
he might be.
The most famous Ben Nye is a maker of theater makeup.
Yep. There's a shop on Marietta Square that has advertisements for Benjamin Nye. So good stuff there. As we think about AI, I mean, who are the winners and the losers? Who's kind of surviving over the last couple of days as earnings reports roll out, Tom?
So it's interesting. The big losers are definitely going to be advertising firms. I don't know if we talked about it on this call, but like AppLovin is just getting crushed. They're the worst performer in the S&P 500, I think, year to date, and they're down 20% today because they're basically being market corrected by AI. DraftKings is getting crushed. That's an interesting market. I saw a headline.
They're getting absolutely dominated by the predictions market.
Well, like the odds are better. That's the thing is like if you pick a long shot on the odds thing, you could make 20 times your money very quickly, and you can cash out as opposed to having to pay the vig, on a line
the volume on the Super Bowl bets placed through Kalshi and others was staggering. Meanwhile, I think the take on Super Bowl betting in Vegas was down.
I mean, it wouldn't surprise me. I worry about that space. It's certainly not one I would invest in because there's just so much competition. Too much competition is a bad thing. That's why we don't like airlines. And by we, I mean definitely me specifically. And I was running into computer trouble, so I put a little note in here that said Trump taps advisory board on, and then I didn't finish that sentence. But there was a list put out yesterday where he's putting together a group of heads of companies to discuss the atmosphere around Bitcoin, trading, the betting markets. So like Vlad from Robinhood is on there.
Oh, yeah.
The CEO of the Chicago Merc is on there. The guy from DraftKings is on there, CEO of DraftKings. So there's a bunch of like weird amalgamations of people, the Coinbase guy, Crypto.com, all these people. And the idea, I think, is to kind of get an idea of like, what are we doing here? How do we regulate this? Because there's so many new things coming to market so quickly. Because, I mean, you could argue that the Kalshi stuff is betting. I would argue it's even more speculative than regular betting.
It's amazing to me that it is allowed.
Yeah.
I mean, it is significantly more like throwing a dart and betting. I mean, you can bet on Bitcoin's closing price in an hour.
Yeah. I mean, I made a nice little sizable sum on riding the reader wave and getting out when he peaked in terms of expectations as the Fed chair. I rolled a little bit of that money into Chris Gotterup winning a major this year. People don't talk about this guy, but he's the hottest golfer not named Scotty Scheffler in the last 8 months. But he's only been on tour for like 10 minutes. And, I mean, he's everywhere. Won the Scottish Open. I think he came in third in the British Open. He won this weekend at Waste Management because Hideki Matsuyama got absolutely destroyed by the gallery. But he's He's just some guy who went to Rutgers who's suddenly everywhere, and he's got great odds on Kalshi for winning a major this year.
I like it. Other winners, I mean, we're certainly seeing a transition in which those who are actually involved in the manufacturing of components that go into hardware for this AI boom, they're the winners. Applied Materials up 12%. Even just sorting through, I was just kind of looking at the S&P 500 data company by company today. Do you know the top performer in the S&P this year?
I don't know. Dillard's?
SanDisk.
Oh, SanDisk. Yeah.
SanDisk.
They're like an old old school.
They're old school.
Original
but I mean,
tech
they
company.
are just, I mean, they make the NAND supply, and there's so much demand for that right now. There's demand for the NAND, and it's been a constrained bottleneck. And I mean, they are just absolutely in a super cycle. They are up 160% this year.
Man, to meet demand, you got to make demand.
Put it on a shirt. Put it on a shirt. So pretty interesting, just when you kind of break down what's going on, because I think a lot of people would say tech is down, tech is dead, but you still have a lot of tech-based winners.
Yeah, the rotations are the thing is nobody's watching the names that are crushing this year. Yep. I mean, we've talked about Huntington Ingalls, which is a ship maker. Like, they've done well. All the defense have done well.
The S&P 500 is down now for the year as of yesterday, with futures being down just a bit. That's likely, as of now, would hold. But interestingly, the equal weight is up about 4%.
That doesn't surprise me at all.
Weight. So we've got 60% of components outperforming. So kind of interesting there. We are seeing some trade thawing in general with the U.S.-Taiwan trade deal coming through, possibly a breakthrough with Iran. At least Trump seems to be alluding to a potential agreement. So I don't know. There's hope for a little bit of calmer waters. It does seem like the overall vibes are no longer boiling over the way they were 2 or 3 weeks ago.
I mean, yeah, it feels like that the first year, call it, I mean, we're pretty much there of Trump's administration where we knew it was going to be volatile. But things are starting to settle down. It was so fast and so aggressive that there was a lot of volatility, but like ultimately things have settled down now. We're getting tariff money. Yep. The Supreme Court seems like they're just going to let that one slide for a while. Yeah, so there's
no rush to make.
No imminent concerns there. Bonds are up quite a bit. The market's quite up a bit since year over year. Yeah. I mean, I think that, man, this move on treasuries could really, I mean, it could put a bullet in the downside of here's what I think is going to happen.
Let's go.
We're trailing on the housing information. Rates are coming down based on future inflation expectations. That's going to drive the housing market because the mortgages are going to come down huge today. People are going to be looking to buy a house. They're going to get a better rate than they have in the last 6 months right now. That's actually going to occur while we're simultaneously getting inflation coming down. So rates will continue to come down. Mortgages will continue to get better. And by the time inflation shows that the housing market is down, we will actually probably be at bottom inflation. And then we'll see housing come back up on a lag. Yep. But that's going to be really strong for the economy. So we'll probably see really nice growth. If we can continue this trend, if we see the jobs data look like the jobs data, whether or not the number is accurate, but if it looks similar as a trend, and we continue to see inflation come down, because the only thing really propping it up right now is the housing market, which is, we all know based on having eyes and ears, is not as strong as inflation is indicating. I think that means rates continue to come down, or at least be in a position where it's easier to buy a house while simultaneously prices are coming down. So affordability increases heading into the summer. And I think we see some strong growth.
I also think on the topic of just sustainability and general calm, I mean, I think it's favorable. I'd be curious your thoughts. I think it's favorable that the expectation for rate cuts, although it exists, is at least reasonable.
Yeah.
For the time being.
I think 2 is what I would do if I was Fed chair right now.
If you're looking for 2 and you only get 1, that's not going to absolutely whipsaw the market one direction or the other. If you're looking for 2 and you actually get 3, it's not going to whipsaw the market one direction or the other. You could have a 50% move from what the expectation is in terms of number of rate cuts, but that's not as meaningful as when people are looking for 8.
Yeah. I mean, I think inflation is really close to 2. And I think that means the federal funds rate should probably be 3. And and if this number is correct, then the reasonable value for the 10-year is probably now closer to a 4.10, which we're right around again. And we could go above it, we can go below it, but I think that's fair value. So that's where you play the ball game. If it's above 4.10, you're buying longer stuff. If it's below 4.10, you have to be specific on your buys. And that's how we've done fixed income the last 6 months, where it's been 4.20.
Yep.
And there's been great opportunity days, and today's not one of them.
I'm seeing the 10-year at a 4.09 right now, and equity futures just ticked positive. So
bing bong, huge day.
Let's go, boys. All right, y'all have a great day. Have a great Valentine's Day. Have a good Freaky Friday.
I would say, hey, subscribe, like. Give us some views. I think we might have gotten quietly shadow banned over some. I'm not going to say the V word again, but I mentioned a V on on I think Tuesday's call, and since then I think we've been shadow banned. So give us a like and subscribe. Let YouTube know that the boys are loved.
Bring the boys back,
and maybe we'll get a little more momentum heading into the weekend.
I mean, I missed 2 calls, and now we can't get any views.
All hell broke loose.
All right, talk to you guys soon. Have a great weekend.